Hey folks, welcome back to the channel. So how do we manage our investment risks? Well, one way is to use the bucket system. If you haven't heard about this before, it's basically a simple and flexible framework that you can think about your investments so that your money can do what you want it to do within your risk tolerance. So the idea is to split your financial assets into different buckets, and the amount of money that you have in each bucket is not measured in dollars per se, but it's measured in time. And that's how much time it's going to take you to draw down or empty that bucket. And each bucket has a purpose going from less risky to most risky. So let's go over an example. If I were using the bucket system, I would probably have three buckets. Some people have two, some people have four. It's just up to you. I think three is not a bad place to start. So the purpose of the first bucket is to survive most corrections or bear markets. It's going to be my safety bucket. And I'll probably have like 3 years of living expenses in this bucket. Because remember, it's not measured in money, but it's measured in how long it's going to take me if I only live off of this bucket. If you have a really stable job, maybe you don't need 3 years. Maybe you can just have 1 or 2 years in there. Some people have 4 years or longer, maybe if they're already retired, so they need that extra cushion. And what you want to have in here are really safe assets, such as cash or cash equivalents or short term bonds. I would probably have it like 90% short term bonds and then 10% cash, something like that. Inflation protected bonds are good as well, as long as they have short durations. So, why does this help when there's a correction or a bear market? Well, a correction is when the stock market falls 10% or more. This happened 26 times since World War II, and it usually lasts just 4 or 5 months. Bear markets are more rare, but they have a much larger decline of 20% or more. This happened 12 times since World War II, and it takes about 3 years on average for the market to recover. So, what happens during these times is you don't touch the other buckets yet. You just use money if you need to from this first bucket, which is cash and short term bonds. So, the drop in the stock market won't affect your realized finances at all because you're not selling the stocks and other investments that go up and down with the stock market. You're just using the cash from this first bucket and you're holding on to all of your other assets. But of course, some market corrections or bear markets last longer than just a few years. So that brings us to bucket number two. And the purpose of this one is to help us survive a really deep or a long lasting bear market. So I would probably put about 5 years of living expenses in this bucket, and I would hold investments in here that have higher expected returns than the first bucket, but are not too aggressive. So maybe like 75% high quality dividend growth stocks that pay regular dividends, and maybe 25% long term bonds because interest rates have ticked up a little bit. Buying bonds is not as bad as it was last year. So, most of the time from this bucket, you can expect a pretty decent return in usual times. But if there is a long bear market and you run out of money in your first bucket, then you have to be prepared to take money out of this second bucket. Now, the third bucket in this particular example is for growth. In most cases, you wouldn't expect to withdraw money out of this bucket. And in my case, I would probably put 10 years of living expenses in this bucket. So it is the largest bucket and it's for growing long term, like 20 years plus into the future. So I would put like Google or Amazon or Microsoft or these kinds of large tech names in here. Also, Adobe and other fast growing companies, those kind of stocks, they would go into this bucket. So, how you basically use these buckets is whenever you need to withdraw money or take out some funds from your account for living expenses, you start from the first bucket. If that runs dry, then you move on to the second bucket. And if that gets depleted, then you move on to the final third bucket. And here's the key thing every year you have to look at your buckets and you have to reassess like what their purpose is and rebalance. So sometimes there is no rebalancing because if we're in a bear market for like 2 or 3 or 4 years, then you just keep drawing from the first bucket. You don't rebalance. But once the stock market hits a bottom and it starts to go back up, then you basically sell some of your assets from the second bucket and then move those funds into your first bucket. So you're going to replenish your first bucket. If the bear market doesn't last very long, then that's really all you need to do. But if it lasts like 7 or 8 years, which is very rare, then you might even have to move some money from your third bucket to your second bucket because you would have used your second bucket. And because most of the time the stock market goes up, most of the time that you're spending money is you're only going to spend the first bucket. And the longer you don't touch your second or third bucket, the more chance they'll have to grow uninterrupted and give you that bigger portfolio later on, should you really need it. So the bucket system works for a lot of people because it helps you visualize your risk. If you only have just a one portfolio and it drops 20% or 30%, that can be pretty painful. But if you see it this way, then you can say like, oh, I don't have to worry about that second or third bucket. I'm still safe. I actually have like 3 years in this case to draw down my first bucket if I really need to until things get worse. And usually things turn around before then. The other thing is you don't want to sell your assets when the stock market is down because then you'll just be selling low, which is not something you should do. And having the bucket system kind of prevents you from doing that because you're drawing down your assets from the least volatile to the most. Using the bucket system gives you this interesting perspective that you can view your finances from. So I hope you enjoyed this video and got something out of it. Happy investing, and until next time.